How do I structure my investment portfolio to limit risk? I'm going to show you, but first you got to do one very important thing. Smash that follow. Hey, thanks. My name is Kenneth and I teach my 350,000 social media followers how to trade, invest, and simplify their lives. And a mistake that a lot of new investors make is they don't ask themselves the important questions when it comes to speculative or high-risk investing. They hear about some trending stock on social media or what some politician or what some company did or a billionaire and they go, well, I'm going to just copy them. Or they scroll through TikTok and they ask strangers, should I invest in this? What should I invest in? And then strangers tell them invest in this, invest in that, and they go, cool, thanks. Don't do that. The mistake new investors make is they always look at these cheap penny stocks and they think, how rich could I get if it went to this price? But they never say, what am I willing to lose? Here's how I structure my portfolio to limit risk. My portfolio, along with everyone's portfolio, should have a solid foundation of index funds, an S&P 500 index fund, a dividend-based ETF, a tech-focused ETF. That's called the 3-fund approach, but I call it a 4-investment approach because the 4th is a real estate investment trust. After that, you can buy individual stocks if you are so inclined, high-quality ones, and then at the very top, speculative investments. It's only going to be made out of money that you're willing to lose, which is usually around 5% of your portfolio. Now, I don't share my portfolio because this account is to teach people how to invest, not to just copy me. So I'm not going to share my portfolio, but I have hundreds, if not thousands of shares in high quality investments. And then the positions get smaller and smaller as the risk increases. So just as an example, most recently, NVIDIA purchased some $3 or $4 million in SoundHound, and the internet went crazy, and everyone was buying SoundHound, and I bought some too. I bought 100 shares because that was the most I was willing to lose. There's a lot of speculative investments that I'm intrigued in. Joby Aviation, Archer Aviation are two that I don't yet own, but I'm considering, and I'm looking at it. Joby is $5.31, so 100 shares is going to cost me $531. I don't sit there and think, if Joby goes to 10, 30, 50, 100, how much could I make? I think, am I willing to lose $531 if the company goes bust? Or even 80% of that money? Am I willing to lose that? That's how I make my decisions. I know that a lot of people like to look to the stock market like it's their get-rich-quick fix and it's going to make them a lot of money, and usually the opposite thing happens.